Today, Snowflake shares tumble after surging more than 100% in their record-setting public debut yesterday. Plus, why one Wall Street firm is making a big call on Domino stock. And finally, this Silicon Valley company is actually paying its employees to ditch San Francisco. I'm MacKenzie Sigalos, and this is CNBC After Hours. It was a down day for Wall Street. All three of the major averages finished in the red, but as has been the case the last 2 weeks or so, the Nasdaq is the biggest loser, as major tech names tumble once again. Apple, Amazon, Facebook, Google, and Microsoft all posting more losses. And shares of Snowflake also dropped today, down more than 10% after surging yesterday following its record-setting IPO. The stock popped 111% after debuting as the largest software IPO of all time. Snowflake captivated basically all of Wall Street and Silicon Valley yesterday as it soared to a $70 billion market cap, the same size as megabank Goldman Sachs. Now, this was great news for the big guys out there, who we call institutional investors. They got to buy Snowflake stock at $120 a share. They more than doubled their money on day one. But for everyone else, they had to buy shares around $245. That's where trading actually opened. So they didn't make a bunch of money on day one, and today they're underwater. Shares closed around $227. This blockbuster IPO has added fuel to a debate that's been building for a few years now about the best way startups should go public, how much they should cost, and who should be the biggest winners. CNBC.com tech reporter Ari Levy has the details on Snowflake, why everyone was obsessed with it, and how some companies are taking a different approach to the IPO process.
The reason that Snowflake IPO is so exciting and so big is because the company is bigger and growing much faster than the type of company that most employees see when they go public. The best way to think about Snowflake is as a database in the cloud. So if you think about technology the way that it has been over the previous decades, when companies want to store data, they've done it in these databases that are tied to hardware in a data center, whether that's in their own office and in the basement, or it's in a third-party facility. Snowflake 8 years ago decided that that's not the way that's not the direction the world is heading. Where it's headed is to the cloud, where everything is going to be in the cloud. And if that's the case, your data needs to be there as well. No company before Snowflake has gotten the kind of scale and growth that Snowflake has received. And so the view is we finally have a company that is poised to be that fundamental database layer for the next generation. The company is doing $500 million in revenue already, and it's more than doubling. So growing at that rate, and their cost structure is such that they're bringing their costs down while revenues rise, so their margins are expanding. The size of the pop was large, but we've seen other stocks double, even triple on their opening day this year. Snowflake is still losing a fair amount of money, which is normal for a tech company, particularly a software company, at the time they go public. The way that these businesses work is that it takes a lot of money to build the product, and it takes a lot of money to find customers. There is a very healthy debate taking place now in Silicon Valley and in the broader investor community about how IPOs or public listings should be structured. Banks know that they're handing out a certain amount of very cheap stock to preferred investors, knowing that those preferred investors are going to come back again and again for future IPOs. T. Rowe, Fidelity, Vanguard, these are these big name investors are part of your cap table. It must be a good stock. Well, they happen to get in at rock bottom prices. Unity, which will debut on the market tomorrow, took a slightly different model in that the CEO and the management company actually had control over the final price and the allocation based on the bid. But another is the direct listing, which Palantir and Asana are pursuing, where they're not actually raising new money. They're just going to list their shares on day one. And then, of course, you've got the SPACs, which have picked up a lot of steam this year. An investor group raises amount of money for a blank check company, and then they go out and find a private company that they want to reverse merger into an IPO. It's largely about how much money is it costing companies to go public, and who benefits from those costs. And with an IPO, it's very clear. It's expensive to go public, and there's a very small set of investors that benefit from that.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
We're sticking to what we have said before, which is based on the current epidemiology, the rate of infection in the country at the location and counties where we have sites. We anticipate our base plan for efficacy for the first interim readout to be in November. That's our base plan.
No more PPP, no more money for airlines. We don't need it anymore. The fact is you have to let some of them go bankrupt, a consolidation. I am convinced that business travel will drop 15 to 20% even after the vaccine hits. I don't mind giving employees some support during this transition, this digital pivot that's occurring in the economy. But I've now come to the conclusion, crystal clear, that 25% of my companies are going to fail. There's nothing I can do about it.
There are three things you're looking at when you look at security. One is the algorithm trusted. Two, can you make sure the data won't be corrupted? And three, and this is the one that I think we'll really have to look at, is a 2017 China national intelligence law says that Chinese companies, citizens, government can be compelled to provide their data to China.
We believe that by going public today, we will be able to basically get the resources that we need in order to grow both organically and inorganically in a way that aligns our shareholders with our mission.
America's big cities are still trying to mitigate the economic fallout of the COVID-19 pandemic. Yesterday, New York City Mayor de Blasio furloughed his entire staff at City Hall, including himself. All 495 staffers will have to take a week-long furlough at some point between October and March. The move comes as the city faces a $9 billion two-year revenue shortfall as a result of the months-long lockdowns. And it might get worse. New reports flood in about people ditching cities like New York for cheaper places to live, possibly leaving the Big Apple with fewer people to tax and therefore less future revenue to raise. And it's not just New York. Another big reason for the exodus, work from home. Without the need to be close to the office, why not get more space at a lower cost? And now companies are actually incentivizing people to ship out from higher cost cities. Fintech startup Stripe is now paying its employees to leave pricey cities like New York and San Francisco. But there is a catch.
So Stripe, the $36 billion payments company, is offering employees an incentive $20,000 bonus if they do decide to leave cities like San Francisco, New York, Seattle that tend to be more expensive and move to another city. The catch, though, they also will get a 10% pay cut. So Stripe is a very global company to begin with. They've already done a ton of remote work. They have a program for remote engineers. The founders are from Ireland. They've got global hubs all over the world. So a company like Stripe, it's not surprising that they might want to attract more global talent, more diverse talent, and look to recruit elsewhere. So other tech companies in Silicon Valley have offered something similar. Facebook said that they would allow employees to move to other cities and work remotely, but again, with a 10% or something similar for a pay cut. Twitter has said the same thing, and both of those companies have said that they eventually want to go to a fully remote or mostly remote workforce. Stripe hasn't said anything along those lines, and they are really the only tech company that's being this generous with the upfront payment. No one else has come out and said, we'll pay you a lump sum to move. All of these announcements also bode well for the tech companies. They will end up saving money in the long term if their employees aren't living in these high-cost cities and they can afford to pay them less. So the big question is it really for the employees or is it for companies like Facebook, Twitter, Stripe, and others to eventually save money on their bottom line? Stripe has about 2,800 employees. They haven't said how many have actually taken them up on this offer to go remote. And one thing to keep in mind, Stripe is not foregoing office life completely. The company is moving its headquarters from San Francisco to the south of San Francisco. They're scheduled to open a brand new office in 2021. So it doesn't seem like they're fully abandoning that in-person work life.
Okay, time for today's numbers round. First up, 384,000. Amazon says that more than 300,000 people attended its virtual career day yesterday, and more than 384,000 people have applied for a job at the company in the week since the event was first announced. 384,000 is a record. Earlier this week, Amazon said it would bring on 100,000 more workers in its fourth hiring spree of the year, as the e-commerce retailer tries to keep pace with growing online shopping demand in the midst of the pandemic. And there are certainly people who need jobs. Some 860,000 Americans filed for first-time unemployment claims last week. Next, 435. One Wall Street firm is betting big on pizza. Analysts from Oppenheimer think Domino's Pizza is doing such a good job delivering pizzas that they named Domino's stock a top idea, with a price target of $435 a share. Domino's closed trading yesterday around $386 a share, meaning that these analysts think the stock can run more than 10% higher than where it's currently valued by the market. Why? Well, they think Domino's is set up to sell even more pizzas through 2021. Oppenheimer says that this sales growth will come from Domino's ability to take advantage of the fact that the marketplace for pizza is largely fragmented. And finally, 499. Sony's highly anticipated PS5 will cost $499, and the company said yesterday that it will be available starting November 12th. A digital edition of the PS5, which will not have a disk drive, will also be available for $399. The stage is set for the PS5 to face off against Microsoft's latest console offerings, the Xbox Series X and the Xbox Series S, which go on sale November 10th. That's it for After Hours, but before we go, here's one more thing to keep an eye on. All day, we've been getting a slow drip of details from the TikTok Oracle proposal currently in front of the U.S. government. We learned that TikTok is promising to file for an IPO on an American stock exchange sometime in the next year. We also learned Walmart is likely getting a minority stake. According to CNBC sources, President Trump is expected to make a decision on whether or not this deal can go forward within the next 24 to 36 hours. Make sure you don't miss it. Check out CNBC.com and download the CNBC app. We'll be right here in our home office every Tuesday, Thursday, and Friday with a new edition of After Hours, so be sure to catch us then.